Hi everyone, Professor Anderson here, and it is time to work on merchandising transactions. Okay, so what is a merchandising business? Well, a merchandising business means basically you buy goods from somewhere else and you turn around and you sell them to customers, right? So the idea being your Targets, your Amazons, companies like of that nature. The idea is that you're purchasing someone else's goods to turn around and keep as inventory on your shelves until you sell it to somebody else. And typically you buy goods at wholesale, which is a lower price. You buy them directly from, the people making the products, and you turn around and you sell them for a retail price. Now, up until this point, really all we've done is service-based businesses. We've done things like we mow lawns and we, provide music services at weddings and things of that nature. But now what we're doing is we're buying products to turn around and to sell to somebody else. Okay, so just a couple of new accounts. Oh, sorry. The difference between wholesale and retail is often referred to as a markup, right? So if you buy something from a wholesaler for $70 and you sell it for $100, that $30 of profit, gross profit, we'll get there in a minute, that's going to be considered the markup on the product that you're selling. Okay, so a couple of new accounts that come along with merchandising, things that we have not talked about before, brand new terms. We have been saying revenue, but we've been saying service revenue up to this point. So now we're talking about sales revenue because now we're selling a product. All right, so revenue from the sale of merchandise. You'll hear merchandise inventory, kind of the same thing. All right, cost of goods sold. That is another very important new term for this chapter. Cost of goods sold is, or cost of merchandise sold, either way is fine, for me anyway. Cost of goods sold is basically the cost of the product that you're selling. So back to that, we bought a product for $70 and we sold it for $100 to regular people, but we bought it for $70 from a wholesaler and we had that $30 in profit. That $70 that we had to pay to get the product to us, the inventory to us, that's considered the cost of the goods that I'm selling. Now there's a couple of things that go in there, but really the biggest item in cost of goods sold is simply that, the cost of acquiring the products that I'm going to turn around and sell to regular consumers. All right. I hate saying this, and I hate even saying it on camera, so it's here forever, but it's kind of like inventory expense. That's not a thing. There's no such thing as inventory expense. But if there was, it would be cost of goods sold. All right. Cost of goods sold is basically the cost of acquiring inventory. All right. And there's, like I said, some other things that come into that as a factor, but we'll get into those other things a little bit later in this lecture. So the cost of goods sold, cost of merchandise sold, is the biggest expense typically on your income statement because if you're a retailer and you're a merchandiser and you're out there selling your products, you have to purchase the products to sell them. So that is going to be your biggest cost. All right, and merchandise inventory, you hear me saying a lot, but basically what I'm buying to turn around and hold for sale. So, like I said, if I'm Target, I'm out there buying inventory from all different types of wholesalers, right? The people making the clothes, the people making the furniture. I'm buying it from them, and then I'm going to hold on to it and sell it to consumers. All right. It is considered to be a current asset, the idea being that inventory really shouldn't be sitting on your shelves for more than a year. Could it? Sure. But it really, in general, is considered to be a current asset. Okay, so let's look at what a merchandiser's income statement looks like. It's considered a multi-step income statement because it's got the same pieces in it, revenues and expenses, but we have a couple of subcategories now. Now, what you've seen up to this date has simply been a single step income statement where it was revenues minus all expenses, and that was it. And it came out to net income or net loss, right? All revenues minus expenses. That was a single step income statement. Let's look at a multi-step. There's a little bit more in here, but at the end of the day, you still come to net income or net loss. It's just going to be how do we categorize the items. All right, so we start off with net sales revenue. Now, why do I have an asterisk there? All right, we have an asterisk there, and we have the word net there because there's more than just selling a product, the revenue from selling a product in that number. If you think about it, if you're a merchandiser, you're the Target of the world, or Targets, or however, or Kmart's, or Costco's, or whomever, and you're selling inventory, typically you're going to have some of that inventory come back to you, right? People return products. That's completely normal, all right? That is going to be considered a return. So if you sell something, but then it gets returned to you, then we really should be netting those numbers together because we didn't really sell it, it came back, right? So there's a couple of things we add together to get that net sales revenue number. I'll get back to that in just a second at the end of this, all right? So from there we subtract, let's go back to the normal. We have net sales revenue. Like I said, we'll get back to what comprises that net number in just a moment. I just want you to realize that there's a little bit of a calculation that goes in there. Minus cost of goods sold, right? That's the cost of the products we're selling. Gives me something called gross profit. Gross profit is arguably one of the most important numbers on the income statement. The reason being is because that sales revenue, back to what I was saying, if we sold something for $100 and it cost us $70, that's 100 minus 70 gives us $30 of profit, right? That profit that we make, that $30, my little example there, has to cover all of the rest of the expenses of business. So basically, the idea is that I have to have a high enough profit on the products that I'm selling that I can then pay my employees, I can pay my lights, I can pay property taxes, I can pay all of the extra costs I have of the business because I have marked the products up enough, I have made enough money on them. I know you've heard about things like the dollar store, they only make like pennies on everything they sell. That's profit. That's that gross profit. Their gross profit percentage is super, super small. And it's really small because what they count on is selling a lot of products. And that covers them. All right. But gross profit and gross profit percentage, meaning how much are you making on every sale, is a really ridiculously important number to know. All right. From there, we subtract selling expenses and administrative expenses. All right. Those two together are called operating expenses. They are the cost of running your business. All right. The selling expenses, the cost of a store, the cost of your salespeople, right? The electricity in your store, the advertising expenses, all of those are selling expenses. Administrative expenses are the cost of running the business, right? Not necessarily the store. So if you're something big, you're like Target. I know I keep going back to that. It's funny because I don't even go into Target. But anyway, okay, Target. Their cost of running their business, like the CEO's salary, or human resources, or the people who run payroll, right? All of those people are not necessarily selling products, but they're running the business. All right. So if you're talking like the headquarters of a business or something along those lines, the people who run like the business at a high level, that's going to be an administrative expense. All right. Those two together are the cost of running your business, the cost of making sales and the cost of running the business. And they're considered operating expenses. So the next super duper duper important item on here is going to be operating income or income from operations. You can call it either one is fine. The idea is that number, right? How much profit I made minus the cost of running my business tells me, am I making money running my business, doing whatever it is that I do? What is my income from my operations, my core business activities? Am I making money from my core business activities? That's what the operating income number is. So that, in my opinion, is more important than net income. Because net income has a few more things you're going to see in a second, but operating income is simply saying, how much money am I making doing what my business is meant to do? Okay, so from operating income, we subtract other items, other revenue, other expenses, the kinds of things that can go in there, like I said, like I'm Target, right? And my business is the stores and selling from the stores. But if I decided, let's say I had just an empty parking lot somewhere in the Midwest, and somebody wanted rent to that parking lot from me, and I'm not doing anything with it. I'm not going to sell it to them necessarily, but like I'm not doing anything with it right now. So I rent it to somebody and I make a little bit of rental income. That's not my core business activity. I'm Target. I sell things, right? But that other category could be rental income from renting out that unused space that I had. That's not my core business activities, but it is in fact revenue, so I do want to include it. All right, things like that fall into these other categories. And then, interest is a very common one. Interest, like if you have interest revenue because you've loaned somebody money, or you have interest expense because you owe money, that's not part of your core business activities either. That's financing your business, but it's not a core business activity. Your core business activity, like your target, is selling things. So those fall into that other category. Interest is a common one that falls in there. Then you get to the subcategory here, income before taxes. Taxes is a large enough number that we look at it on its own. So then we have tax expense coming out, right? Because taxes, everybody's got to pay taxes. And then you get to your net income number. Okay, so at the end of the day, all of these things would still be in here, but we wouldn't have these subtotals. And these subtotals are important for running your business. All right, just to finish this off, let me talk about this net sales revenue for a second. What is net sales revenue? We take all of our sales, total gross sales revenue, everything that we sold, but then we subtract from it sales returns and allowances. Sales returns is kind of the big one. Sales returns is, did somebody return the products that they bought from me? That's a completely normal thing in business, right? People returning products all the time. So you would take everything you sold minus what people returned to you because it came back to you. And we'll get through journal entries for these a little later. And we subtract something called sales discounts. Sometimes we might sell to people and we might say 20% off, right? We've all bought things that are a percentage off. You know, this week only, buy this for 20% off. Okay, that's a sales discount, okay? So we'll get into some of these things with journal entries in a bit to show you how to illustrate them a little bit more, but then that gives you that net sales revenue number. So it's total sales minus the sales returns minus sales discounts gives us the net sales revenue. Now, all of these, sales revenue, sales returns and allowances, and sales discounts, have their own T accounts. They are their own ledgers. All right, we're keeping track of them. They are their own accounts. They're netted together for sure because you want to look at if you have sales revenue, you want to look at the offsets to that as well. But those three are looked at together, but they are their own individual 3 separate accounts. Okay, moving on.